Okay, welcome everyone. We'll start our second lesson. Today lesson will go through LO2 learning outcome to be able to assess the impact of relevant taxes in a given situation. So in different scenario can be different tax implication. So we always need to be look around the client's situation and then we need to be advised. So to be betterly advised, of course, we need to be look around the various options and then we can. And to look around various options, we need a good information. If we don't have a good information, you can't make or can't advise your client accordingly. If we don't have a CPD, last lesson we discussed about professional code of ethics. Do we know what those were, please? Professional code of ethics. Let's recap first what we learned during our last lesson.
PPCIO.
Excellent. PPCIO. We discussed what. Okay, what first P stand for? Professional behavior. Of course, always we need to be make sure we'll keep professional behavior. Yes, not contradict, not conflict of interest. And second was professional competencies. Competencies and due care. Anyone knows what is meant by? What is this professional competencies and due care? How we can compromise this? Okay, do we know CPD? How many hours we have to do in a year?
40?
Quite close. If you're a full-time employee, 37 hours a week, you're supposed to be around 35 hours a year. You're supposed to keep the key CPD record. And especially if you're in tax, so your CPD relating to the tax affairs. That's up-to-date knowledge. If not, we can compromise. If you're not competent, do we know difference between competencies and capabilities? Anyone heard about before? What is the difference between competencies and capabilities? Okay, if you pass your driving test, you're capable. If you pass the course, you're capable. Maybe you're not competent. Competent mean up-to-date knowledge and skills. Yes, that's, we need more competency. That's why newly passed driver few weeks, need to display the plate on the car because we can make mistakes. So that's why someone's supposed to be supervise you or mentor you, check your work. Okay, third we discuss confidentiality. Can we declare information to anyone? Or when we can declare the information? We're not supposed to declare to anyone. We can only declare best interest of the public. When law says to declare, when client give the authority. And last we discuss about objectivity. Okay, anything else we discussed last lesson? Do we remember? What we learned during our last lesson, please? Yes and no? Anything you remember from last lesson, please? Anything else other than, of course, we discussed ethics.
The parent company controls subsidiary 50% or more shares, associate 20 to 49%, tax-free redundancy 25,000.
Excellent. So we discussed parent, we discussed subsidiary, we discussed associate element. So and otherwise is a simple investment. So 20 to 49 is associate, 50 or more is subsidiary, and if less than 20 is a simple investment. Well done, great. So these are the major, we discuss about domicile, we discuss about what impact will be tax system. That was all our discussion during our last lesson. Today is more about the tax returns, how we can in terms of businesses, in terms of individuals. So that's, you can rate yourself 1 to 10. What do you think? How much you know? Do we done the CTC 600 form? Have we done the self-assessment return for individuals? We know the VAT return. So you can rate yourself, huh? You want to reflect? What do you think? 7, okay, good. Yes, please, if you want to reflect, always good to be reflect, at the start, at the end as well, huh? Okay. Today lesson is indicative contents, what we look, uh, key advice, the required to supply the tax applicable to the specific situation. So today lesson is different scenario we can look around. Yes. And how we can advise to clients, if we don't have a CPD, we don't have up to date information, we can't advise. To develop your further understanding each area, I copied the link for you here. So what you can do, copy this link please in your own time. Yeah. uh, and you will see here, I'm going to share with you, these are different scenario. So that's really good document, will help you. Okay. So if you look in different situations, yeah, in different scenarios, like saving income, you have want to advise somebody, so you have a saving income scenario, yeah, which is saving dividend, if you're dealing with a dividend. So there's a lot of examples you can look around and develop your NI contribution, transfer allowance, car benefit in kinds we discussed, so that's quite good. You can look around written down allowance. So these are different scenario, and then you can advise. I pick, one or two, so which we will go through during our lesson. Okay. Anybody, any question? You can stop me, please. You can ask me. Yeah? Okay. That's, and I left the slide, all the rates there still. So let's carry on across, and then we apply the taxes to the given situation. So calculating income tax, component, savings, total all component, net income, and taxable income. We've been given the rates, it's still the same. For this year, almost, so this is example, is a scenario. So let's please, can we quick, read this scenario. For example, we are looking at the 2021. Joe has a salary of 46,500 and saving income 2,000 and dividend income is 600. During the tax year, he paid the interest of 300, which was for the qualifying purposes. Joe employer deducts 6,800 in PY from his earning and the income tax payable by. So that's we need to calculate. Okay, what do you think? Can we try? We can calculate how much tax need to be paid. What do you think? What will be taxable income first, of course? Okay. Uh, this is the scenario. We can look around, of course, we can see, do we have that, if not, we'll need to look around good few questions to develop. So first of all, always we have a non-saving income, which is the employment income. We can use the forms even, and of course nowadays it's electronic, so we can fill. Saving income, dividend. So first employment income 46,500, then the saving income 2,000, then the dividend income 6,000. So total income is 54,500. Interest paid, which is expense. Personal allowance 12,500 from the total we can. So what is now? So total income is 41,700. That's the taxable income. Okay, now your personal allowance we can minus from the employment first. If my employment is not there enough, then I can move to the other area. So after 33,700 is, so what tax rate will be applied here, please? What do you think? Do we know how much tax will be applied on this one? 33,700? Hello, can you see the slides? So how much tax 33,700? We use the personal allowance, yes? So we can calculate this 33,700 at the rate of 20%. From after the personal allowance 1 to 37,500, we have a tax rate 20%. So that's our 6740 is the tax. Then 500 saving. 500 saving is exempt if you're a basic taxpayer. You're a basic taxpayer because you fall in the basic, the tax bracket. Then of course it's exempt. So if we go back to your rates, look around rates. So 12,500, that's first to 37,500. Saving income basic rate is up to 1,000. This in that scenario, that's not a basic, that's a higher taxpayer. So the limit will be reduced. Saving limit is 500 instead of 1,000. Is it clear? If it's not clear, please ask me and I'll explain you. So then that's a 20% tax on it. After the exempt saving limit, that's a 300. Then dividend. So go back to look around the dividend rates. So what is the dividend rate? Dividend income, nil band, first 2,000 is exempt. Then afterwards, dividend is 32.5. So basic rate is 7.5 instead of, so if you withdraw the dividend, 1 to 37,500 will be 7% tax. Otherwise, will be if you're a higher, because this is a higher taxpayer, so 32.5 will be because the dividend rates change last 2-3 years goes. So you will see there. That's why people. So this is now 4,000. We 30 after the exempt payment 32.5%. So 1,300 tax. So total tax liability 8,340. So pay why we already paid the tax and remaining is our tax liability. So the saving income and dividend nil rate band, which means many taxpayers don't have any tax liability in the respect of saving and dividend. So because we have a free limit there. So any question, anyone? Yes or no, please?
No.
Then we have second, analyze the advantages and disadvantages. So that is it. We can look around the tax planning side. Tax planning is illegal. We can advise and we can look around what advantages can be for or what disadvantages if we don't use it. So we've been given here scenario. We have Donald and Teresa is married couple having regular annual income following is a salary 60,000. In term of Teresa is salary 18,000, interest 2,000, dividend is 9,000. It is clear from the above information who is the higher taxpayer. Donor is the higher taxpayer. His income after the personal allowance is 47,500. And Teresa is a basic taxpayer. Income is 16,500. So 18, 2 plus 9 and minus 12. So 16,000. So in this situation, it would normally be the case that the tax planning purposes would be advisable to see if any investment income could be moved from higher tax rate taxpayer to the basic tax. So that we can look around because we can save on it. Okay, so next, however, is not applicable to Donald. Only his income is a salary because there is a no investment income. So the nil rate band, however, this means the above example of tax saving can be achieved. First 500 interest income could be made by Donald because we get the free, and therefore the use of the saving income nil band 500 currently being. We have come to. Hello.
Hello.
Any question, anyone here?
No.
Okay. So the income is being taxed 20% on Treasury. Saving income is excess of nil band. Okay, 1,000, then 2,000 minus 1,000 and 1,000 will be 20%. If we transfer 500, that will be £100. Okay, the second transfer would be sufficient shares to move 2,000 of dividend income from Teresa to Donald in order to both use their dividend income nil band up to 2,000. That's we can. Okay, so we've been given some scenarios. I copied the link for you here for that if you want to look around. So always we need to look around what advantage can be, how we can save the tax, and in different scenarios. Okay, any question? If not, we can go to the next. 2.3, we've been asked assess the statutory, which is mean legal requirement imposed in a given situation, including the implication of non-compliance. So think about, we have a filing date self-assessment. If you do online tax return up to the 31st January in following year end this year, so if you don't do it afterwards, initial penalty is 100. After 3 months, more than 3 months, £10 per day, maximum to 90 days, and the return more than 6 months, 5% of the tax minimum is a 300. Return more than 12 months late is 100% tax due. If deliberately are concede, so it can be compliance on the financial side as well. And other we can look around, we can be bad press as well. Penalties for errors can be deliberately errors. So this is here is the ethics come. Think about, we are struggling cash flow as a company, and your senior says VAT return, and what we do, we don't show the transaction of 10,000 in this VAT return, and in the next, sorry, we make mistake up to the 10,000, we don't need to be filled a separate form for it, and we can show in the next the VAT return. And for the time being, We can save the cash because otherwise we have to pay to HMRC. So what do you think you will do or you don't? Otherwise your business and our job at risk. What do you think you will do or don't? So what advice you will give to the senior? You will accept it if your boss say, will include this transaction in the next return? It's not a objectivity. It's not a professional behavior. You can advise, if we don't pay, we need to pay 2.5% interest on it if late, and that's, other way to deal it instead of we can intentionally. It's not ethically and morally correct. Rule says if we genuine will make mistake, we can declare in the next. Careless, maximum 2. So we need to look around what the charges can be if we don't do. So these are all deliberately and concealed and errors in the fraud. So fraud is come under the Fraud Act as well. So that's deceptions can be. So penalties for the late notification imposed. It does not notify the chargeable by the 5th October the following. Maximum 30% unprompt disclosures, 12 months, greater than 12 months. So these rates will be applied. Okay, the record must be in general be kept until the later 5 years after the 31st January. So it's mean technically the 6 year. Huh? So failure to keep the record could be leads to 3,000 penalty for each tax year concerned. Okay, payment of tax. Payment on accounts must be made, and the payment on account is a 50% of the prior year tax liability less the tax suffered at the source. So we can set up, direct debit as well. We can make the payments. Okay, just on the late payments, of course, not more than 5 months after the penalty, 5% unpaid tax. More than 5 months, but not more than 11 months, tax 10%, and more than 11 months after the penalty is 15% unpaid tax. Then if we don't comply with it, non-compliance may be result in fine, litigations, and other consequences for the client, may have a material effect of its financial statement. We may be not telling the tax side in the true and fair importance, such as the non-compliance may be wider public interest implication in terms of the potential substantial harm to investors. Like Facebook, 4,000 tax, 75 million in the eyes of the clients. So that's the really, and in terms of all these big, the 5, 6 chartered firm is being penalized and their goodwill is really decreased. So general public, for purposes of this section, act, the causes substantial harm. So we need to be make sure we should comply, with all the compliant rules, and we'll look around the tax. Professional accountant who encounter are made, aware of the matters and clearly inconceivable are judged, by their nature and the impact on the financial, otherwise on the client and the stakeholders and in the larger and the public. So we need to be make sure we'll comply with all the rules. That's what we can look around in different scenarios. Okay, 2.1, if you want to go through the merit criteria, assess the effect of the taxation on the financial decision making individual businesses. Okay, so that's huge. You may be heard about, and in America, is it corporation tax was high, and during the Donald Trump government, the corporation tax was reduced. Corporation tax was quite low in Ireland, and the pharmaceutical company Pfizer, they decide to move their head office to Ireland, and because where is the head office, all the incomes come to head office, and the tax, where the company's head office is registered, the rules apply. So a lot of rules is changing now. Wherever you earn from, whichever part or the section, the strategic business unit earn from the world, you should pay the local tax according to. That's huge, because that's why the many company they not pay the tax even they earn the million, because they used to transfer the losses from different part of the world or investment and allowance to make adjustments. So we need to be look around this, the rules. We have a corporation tax. Do we know how many percent now?
19.
19%. Yes. So think about it. It used to be 32%. Is a huge, impact on the businesses. And if you're moving your head office into the lower tax areas, of course, it is a huge saving as well. So your business maybe become affected by the sector tax, which mean, important to ensure the comply with any sector tax obligation. As well as this, may also be opportunity to reduce your tax cost. So we will look, how the taxation can affect your business. Implies, don't often need to be spent. So as expert, we can look around and possible options. National insurance, how much is how much is allowance for available for employer? NI
3,000.
3,000. Well done. So that's available. So we can look around and we can advise to employers as well. However, running own business, very different ways. It is important your responsibility for paying the tax. So we need to be well aware of the tax side and the compliance side as well. So corporate tax are the business taxes charged on the profit of the company, which we know all, and similar. But the companies mean soon your business start making profit, it needs to be start paying the corporation tax at the correct rate. Business taxation affect the business costs. Example, rise the corporation tax has the same effect, increase the cost, which can lead to the raised prices within the business. Ultimately, so other we know the VAT. What is the VAT rate at the moment? Is the 20%. We all know. Do we know how many types? What is the standard rate? Which is, and what is the reduced rate? Standard rate is a 20%. What is the reduced rate?
5%.
Excellent, 5%. Any example of 5%? Any product,
Red diesel.
Yes. And
Hospitality.
yes, good. And energy for domestic use, 5%. That's a huge area. If the client has commercial business and has an apartment, but the 1 meter is connected, we are using 60/40s, or 40% we're using towards business and 60% we are using towards domestic flat. So in that case, VAT can be reduced to 5%, and we need to fill the form. It's called VAT reduction form. And in different scenarios, we need to look around how we can deal with it, zero rated and all others, depends upon the scenario, and we can advise to clients accordingly. Okay, then we have different schemes. We know VAT schemes, annual account. Yes, we know the limits, 1.6, and we can make installments, and advantages of disadvantages of this scheme. Only one return. So all we can look around when we advise cash accounting. Only you pay VAT when you receive the cash. So there is no bad debts. Cash accounting can be used with annual accounting as well. And we have a limit here, 1.3. So that's, we need to look around. Flat rate scheme, and thus we need to be look around. We can advise to clients no more than 150,000 if the business turnover need to be, that's the key elements, and we can advise accordingly. Then we have evaluate the alternative ways of personal and business outcomes may lead to the different tax consequences. Of course, self-return as a company, and we have a different, so we can look around all possible options and we can advise. So CTC 600 due with which, the later by the 12 months after the end of the period, 3 months after the notice required, the return was issued, and notice to be inquiries to be returned must be given 12 months after the later dates and filing dates. So all, we need to be follow. Okay, payments due. Larger company must pay their corporation tax in installment. Other company must pay their corporation tax in 9 months and 1 day after the end of accounting period. So we need to be look around the tax points as well. Upper limits. So limited company have related 51%. Group companies prepare their account for the 9 months, and the upper limit this period is. So we can look around the different relief available, margin and tipper relief, research and development. Do we know what is the difference between research and development? Which which one is asset and which one is expense in accounts? If we'll spend money on research is the expense normally treated, but if we reach the development stage and we can treat as asset whatever we spend in the then if it come under the asset definition, then maybe we can entitle for capital allowance or relief, as well. Less than 500 employees company, and either the turnover is 100 million, balance sheet is 86 million, spending money on research and development, consumer transfer material, computer software. If the relief is created and increase the loss, and we can look around these, we can transfer it and we can cap it up to 14.5%. So the relief. Then IR 35. Do we know about IR 35? What is about?
I do, yeah.
So the company must normally file the CTC return filing due, and this is, it's new, of course we need to declare, especially now, is it self-employed, from, it's supposed to be this year from April, IR 35, the filing, especially like, the lot of investigation going around. Some doctors have set up own companies and locum, they're getting money, but actually the tax HMRC not getting. So in the return of IR 35 in company, they have to inform to whom they paid, and then the HMRC can check, the tax return is being submitted in a way or not, properly reflecting the taxes or not. It's near to me. So that's we need to be look around. Changes the basis of the period. We can three different scenario: commencement of trade, ongoing businesses, or when we cease our business. So the tax rule as well. So first year in which the business commenced the trade, assess the profit from the date of the commence following 5th April, and the second year see the flow. So is there the accounting period ending? Is the 12 months long? Yes, assess the profit those 12 months, normal, current year's basis. Then if no, if the less than 12 months, assess the profit first 12 months of the trade. Is the greater than or less than? So we need to be proportionate. It can be overlap profit. So third year, so we can use the rule here, overlap profit, and we can calculate the tax liability accordingly. So the total profit, this is the pro forma. We've been given the trading profit, interest, other income, property income, chargeable gain, and total profit, and less, qualifying donation and charities we are paying. Okay, these all been explained. Accounting period, we know already, we discussed computation of corporation tax. Then we can submit and we can know is a 19%. Sorry, it's slightly old, this one. and we can focus, on if the loss is, we can carry forward as well. We've been given here is example of, it's slightly old, but we can look around, the current year rates. So our lab profit, if we have, so we can minus and we can put it under the IEF, and that's, So further, please to look around the compliance side is the link here when we do the return and the standards as well, and then all examples of different benefit in kind, inherent tax. So please go through this link, for different, if you want to enhance further your understanding about. Okay, that's all today from my side. So we discuss about, how we can and what sort of the things we need to keep in mind, and how we can look the tax planning and how we can advise to clients. So that's all today. And if you have a question, please you can ask. And all the handouts should be on Moodle now. And in between, if when you go through these scenario, any question you not get, so please you specific ask me, say, I'm not getting this, and we can dig out and we can look around within the rules and within the tax rate as well. So that's all, we've been given all the examples. It's quite good, 33-40 examples, so we can look around as well. So all this is the latest and the finance sector, which apply now. That's all, and hope so I'll speak to you during our next lesson. In between, if you have any question, please drop me email. Sorry, I'm sometime a bit late reply in emails, but I'll make sure onwards reply your email. And my marking finish deadline other place, so I will be slightly late. Thank you. Thanks for attending today, and I'll see you next. Thank you. Bye bye.